The average 5-year fixed mortgage rate is 4.99%, and the average 5-year variable rate is even higher at 5.8%. So even with the Bank of Canada holding here, anyone looking to lock in a new mortgage today is still facing dramatically different rates than just a year ago. For more, we're joined by Samantha Brookes, CEO and founder of Mortgages of Canada. Samantha, always a pleasure to speak with you and get a sense of what's happening from your perspective when it comes to mortgage rates and what people are facing out there. I wonder what it's been like over the past couple of months. Have you seen any fluctuation in mortgage rates being offered right now?
Yeah, so we are seeing a decrease in some of the fixed rates. They had gone up pretty high around the 5.89% range, but now they're, most lenders are down to 4.99 as an average rate because the bond yields have come down too as well. So right now we are seeing some decrease in the bond yields, which is affecting the fixed rates, which is a great thing for homeowners and buyers.
With the Fed sort of, declaring that there's more work to be done here, though, I know that's what's happening in the U.S., but it impacts the bond market. What are you expecting for mortgages from here on the fixed rate side of things?
Well, overall, I think as long as Canada keeps an eye on what we need over here, we don't necessarily have to keep following the U.S.'s trajectory, right? We've seen that last year the Bank of Canada had their own projections, and they did their own increases when the U.S. Feds didn't. So as long as we focus on what Canada needs, then I think overall we should be okay. And overall, I just hope that the bond yields continue to come down and make it more affordable for Canadians.
So I mentioned before the break that it might be a sigh of relief for variable rate holders who have been dealing with these rate increases over the past year, 8 rate hikes up till this point. And for someone who perhaps their payment actually fluctuates with that variable rate change, that could be, quite a squeeze. But it could also be quite a shock for anybody who needs to renew their mortgage right now. How do you suggest that people approach this in sort of the best way to get the best deal?
Well, right now, I'm not advising. And again, if as many interviews as I've had, I always tell people, well, I'm a variable girl, but I'm going to say this. Right now is not the time. It's not the time because we don't know what the Bank of Canada is going to do. They say that they have more work to do. There may be another 0.25% increase. I think people are feeling the pinch right now. And so going with a shorter term fixed rate may make more sense for most homeowners or home buyers right now. The fixed rate is lower than the variable rate. So it just makes sense. You go for a 2-year, 3-year, but the 5-year seems a little bit too far out. And I feel that if consumers were to lock in and the rates start coming down, that they're going to feel like they got gypped. So, a shorter term in the fixed market might make sense for homeowners or home buyers.
Is that sort of the marry the house, date the rate saying?
Yes, exactly.
Okay.
It's a temporary fix.
And when it comes to getting a short-term fixed rate, like you were talking about there, are there costs to that? Are there penalties or any other things that you should be aware of if you're going into something like that?
Yeah, whenever you're in a fixed rate term, if you decide that you need to break it for whatever reason, whether you're going to be selling or you need to consolidate debts or whatever it is, you will have to pay a penalty to get out of that fixed rate term because it's a contract. Whereas if you're in a variable rate product, you only pay 3 months interest penalty, and that's it. So that's why a lot of people like the variable. I like the variable for the flexibility. A lot of people don't like it because it has a chance of increasing with the Bank of Canada whenever they raise rates. So most people can't take that risk.
Are you seeing more people needing to go with private or alternative lenders these days?
Yeah, so what's happening there is, people they're going to renew and they're not necessarily signing with their current bank because they need to refinance. Yeah. So if they're consolidating debts and they need to refinance, they may want to go with a different lender. If that happens, sometimes what's happening is they no longer qualify because we have the stress test. And two, the ratios are out of line. And so if the ratios are out of line, we may need extended ratios. That's when they go into the alternative side. So we're seeing a lot of, homeowners going into the alternative side, but I tell people it's not a bad thing. The alternative space is not bad. It's keeping the roof over your head. It's temporary. And eventually when things settle down or your finances are back in order or rates are down or they may remove the stress test, you can always shift back into the A side or with a bank. So it's a temporary solution. And, a lot of my clients that have gone on the alternative side are now back with the bank. Sometimes I don't hear from them again. They're like, oh, you know what? We were able to go back to the bank. And that's exactly what we try to do, is to help the homeowner get back into the space. So,
are you coming across anyone, Samantha, who's in that sort of crunch where the value of their home has decreased and that's complicating things when they go to renew or refinance?
Yes. We have one right now. I'm telling you. Okay, let me just be completely honest. I won't tell you all the details. But we've been working on the file since November, and this client had a previous broker, and they kind of stopped communicating with the clients, and the property value has dropped so much that we're not able to actually place them. They need 85% loan to value, and we just can't seem to get them a private up that high. And it's really making things difficult. People are, even private lenders don't want to go that high because they don't know how much more the market is going to adjust. And it is a risk for them to put their money into something like that. So, people are getting squeezed out. I'm mentioning this particular client just because it's the one that I just can't seem to get done.
Yeah.
But there are others like that too as well who may need 81% or 82%, but not 85 that we can get done. But the 85 is really, it's a risky investment for a private investor.
Interesting.